The Department of Justice just served Federal Reserve Chair Jerome Powell with criminal subpoenas, the first time this has happened in over 70 years. Here's why it matters for your retirement and investing. The last time politicians pressured the Fed like this, it triggered devastating inflation that wiped out retirees' purchasing power. So in this video, I'm going to show you exactly what's happening right now in the markets, tell you the incredible true story of how one man saved American retirement security in 1951, and give you a framework to protect your savings whether this crisis gets worse or gets resolved. By the end of this video, you'll understand the warning signals, know what history teaches us, and have a specific strategy for keeping your retirement on track no matter what happens in Washington. Let me take you back to 1951. World War II is over, but America was fighting in Korea. The government needed money, and lots of it. They had to make a deal with the Federal Reserve. No matter what happens, keep interest rates at 2.5%. If nobody wants to buy our bonds at that price, just print the money and buy them yourself. Does this sound familiar? Something like might be going on right about now? It should. Now, there's this guy named Mariner Eccles. You've probably never heard of him, but he's the reason your dollar has any value today. He was chairman of the Federal Reserve, and he could see exactly where this money printing was heading. Here's what was happening. The economy was booming. People were buying cars, building houses, starting families. Money was flowing. Factories were running full steam, and on top of all of that economic activity, the government was spending massive amounts on the Korean War, all financed by the Fed's printing press. When you flood a hot economy with printed money, prices start rising fast, and inflation runs higher. Eccles watched inflation creep higher and higher. He knew that if someone didn't turn off the money spigot, well, every American's life savings could be wiped out slowly but surely over time with the eroding impact of inflation. But every time he tried to raise rates to cool things down, the Treasury reminded him, keep rates low. That's an order. This set up one of the most dramatic confrontations in American financial history, and something that rhymes similarly to what we saw from Mr. Powell with his most recent video that he addressed the American consumers and economy with. Picture this, the President of the United States lecturing the country's money managers about their patriotic duty to keep financing the government cheaply. After the meeting, Truman's team issued a press release claiming the Fed had promised to keep printing money. But here's the thing. They hadn't promised anything. Eccles was furious. He knew this was a power play to force the Fed into submission. So he did something almost unthinkable. He leaked the confidential meeting notes to the press. Something that rhymes similarly to what Mr. Jerome Powell recently did with a video addressing this to the world's economies. This wasn't a bureaucratic disagreement with Eccles. Eccles was putting his entire career on the line to defend a principle. He was saying the Federal Reserve will not be bullied into destroying the value of American money. Finally, March 4th, 1951, the Treasury-Federal Reserve Accord. Simple but revolutionary. The Fed would no longer be forced to print money just to keep government borrowing costs low. From that day forward, the Fed had real independence. The kind that could say no to politicians when protecting your money required unpopular decisions. Eccles won the fight for sound money. And for 70 years, that independence has been the invisible shield protecting American dollars. The most direct parallel to today is President Richard Nixon's pressure on Chair Arthur Burns. Nixon wanted easy money to help his 1972 re-election. Recordings from the Nixon tapes prove he explicitly urged Burns to expand the money supply. The result for retirees was a permanent 8% increase in the U.S. price level within 4 years and a decade of devastating stagflation. When a central bank loses independence, it is a long, expensive time to win it back. We are now facing a concept called fiscal dominance. This occurs when a government's debt is so high, projected to hit 150% of GDP, gross domestic product, that the central bank is forced to keep interest rates low just to keep the government solvent, regardless of inflation. Former federal chair Janet Yellen has recently warned that the preconditions for fiscal dominance are clearly strengthening. For a retiree, This is a form of financial repression. It is an intentional move to keep interest rates below inflation to erode the real value of government debt, which effectively taxes your fixed income savings to pay off the national ledger, something of which we are working to get our way out of, arguably not as fast as many of us would like. Now, let me connect this to what's happening today, because those strange bond market signals that I showed you earlier, they're the ghosts of 1951. When investors see a Department of Justice investigation into the federal chair, when they hear political pressure for rate cuts, they're making the same calculation Eccles did 75 years ago. They're asking, what happens to our economy if politics override sound economic policy? Short term, they think politics might win, forcing rate cuts regardless of economic conditions. But long term, they're demanding protection against the possibility that a politically controlled Fed won't be able to fight inflation. They want their bonds, their investments, to keep up with inflation. Simple as that. Here's what this means for your retirement. First, your bonds. Those rising long-term rates mean that the bonds that you own that are longer in duration today are going to be worth less than they were last month. Nobody wants to buy your 3% bond when new ones pay 4%. Here's the key. If you hold quality bonds to maturity, individual bonds, you can still get your full investment back. So keep that in mind of the vehicle of which you're investing and the duration of which your bonds are. Second, your stocks. Markets hate uncertainty, and this political drama creates uncertainty. Plus, higher long-term rates make it more expensive for companies to borrow and grow. That is a headwind, and it is something that stocks should command a higher, what's called risk premium, than what they could otherwise get in safer assets like cash or bonds. And third, most important, your cash. If federal independence gets compromised and inflation accelerates, every dollar in your savings account buys less tomorrow than today in an accelerated pace. And a little bit of inflation is good. The Federal Reserve's mandate is to be keeping inflation in check. Their target is 2 to 3%. And also make sure that the world's worker bees are continuing to work and employment remains in check as well. Inflation is the silent thief that can steal 2/3 of your purchasing power, whether you know it or not. The story of Mariner Eccles teaches us something crucial. Principles matter. Institutional strength matters. The 1951 Accord didn't just solve a crisis. It built a foundation that has protected American retirement savings for 3 generations. Yes, the markets are concerned, but our system has survived much worse. So here is what I would consider as we move ahead, and it's based on the same principles that guided Eccles. First, don't make emotional decisions. The worst that you can do here is panic and destroy a well-designed long-term plan based on daily headlines. Remember, Eccles didn't react emotionally. He acted on principle. And while Eccles was not managing individual retirement portfolios, he was doing something much larger. The principle remains true. Second, review your strategy, not the news. If current events are making you nervous, use that as motivation to ensure your plan is properly diversified and aligned with your goals when you might need it. Ask yourself, am I prepared for different political environments, different inflation levels over time, and different scenarios? And third, remember, this is why diversification works. Concentration can balloon wealth, it can also destroy it. A well-built portfolio is designed to handle exactly these uncertainties. When bonds struggle, other assets might hold steady or even benefit from them. So what we're looking for in a diversified portfolio is assets that are not highly correlated. Said another way, they don't all move in lockstep together. Some non-correlated assets will be something where I'll put a link in the description below on which you can look further into. The higher the percentage, the more correlated those asset classes are. And finally, keep perspective. Eccles fought this battle in press rooms in the White House. You fight yours by staying disciplined with sound financial principles and guidelines for making sure that we're approaching these in ways that we can benefit from. You can't control what happens in Washington. You can't control bond market signals, but you can control whether you stick to the principles that have worked through every crisis in modern American history. The same independence Eccles fought for, the independence that protects your money from political pressure, that's the same independence that you need in your own financial decision making. And this is where I'm partial towards working with an independent advisor who can make sure that we're assessing the risks and the correlation within your portfolios that we can allow ourselves for more of a smooth experience over time. Look, I know this stuff can feel overwhelming. It is designed to. But here's what I've learned helping families navigate financial uncertainty for years. The people who sleep well at night aren't the ones who can predict the future. They're the ones who have plans strong enough to handle whatever comes. Plans that are not brittle and are flexible to changing market environments and life circumstances. Mariner Eccles couldn't predict exactly how this fight would end, but he knew that protecting sound money was worth the risk. Your job is not to predict whether the latest challenge to the Fed independence will succeed or fail. Your job is to build a retirement plan that can thrive either way, with an independence between different asset classes. Be careful who you get your information from while staying informed, stay disciplined, and remember, every successful retirement was once just a plan that someone stuck to through uncertainty. If this helped you understand what's really happening with your money and how to think about protecting your retirement, hit that subscribe button and the notification bell. And remember, we're not just here to scare you about problems, we're here to build retirement solutions. Real financial wellness isn't about perfect timing or predicting the future. It's about having clarity, having a resilient, flexible plan, and having the grit to stick with it. Thanks for watching, and I'll see you in the next one.